Okay, let's go back to the board and how do you win in a bear market, part 2. All right, this graph is a representation of a 10-year period looking at the MSCI EFA index, which is the S&P 500 for international stocks, okay? We went back through 2000 through 2010, and yes, the market dropped down and it went up and it dropped down and it went up, but basically the return was a meager 5.6% return. It was really considered to be a lost decade for international investing. So what we did is that we went ahead and did this study and we started to go inside the numbers. And so we're going to use a little bit of statistics. So I hope I don't lose a lot of people here, but this is what's called the normal distribution or bell curve. Okay, so you're going to have all these expectations or observations within that 10-year period are going to fall on this graph. 2/3 of it are going to fall within this period here. They're going to be small winners and small losers. You're also going to have about a 16% that are going to fall on this large winner side. That was the period from 2003 to 2006 and 2009 and 2010. The other side, the other 16%, you're going to have some very large losses. From 2000 through 2003 was down 31%, and 2008 through 2009, that market was down 41%. So what if I could get rid of some of these large losses, kind of diminish them, mitigate them as much as I possibly can, and just kind of get them out of my portfolio? What ends up happening is I put them up here, but I start to return that 5.66% return that you had if you bought and hold during that period changes to a 91% return. So instead of a decade where I lost actually or made no money, I actually now almost doubled my money. So avoiding these large losses or this weakness in your portfolio is so important to the return of your portfolio. Okay, so let's recap again. I want to hold on to that strength, and I want to avoid and I want to cut and sell those losses in my portfolio. Now, I know I went over some of these examples last week, but I added a few more: Coinbase, Bitcoin, Shopify, NASDAQ, small caps, etc. I want to, again, eliminate those as fast as I possibly can out of my portfolio, because these are the things that drag down your performance and drag down your overall returns in your portfolio. Okay, so we want to eliminate that weakness as fast as we possibly can out of our portfolio, because I can always buy them back at a later date. And I'm going to show you a couple of examples. Okay, you may have heard of this company. It's Intel. I actually went back from 2000 through today for Intel. Now, during the dot-com period, Intel dropped 90%. 90%. Okay? Through 2008, it dropped another 67%. And it took 17 years until that mark got up to where it was at its peak. 17 years just to break even. And it shot above, and it's actually through yesterday or Friday, it's at $38.71. So it's actually below again where it was 22 years before. Let's look at another example. Cisco. This was the Google, the Amazon, the Facebook, the Microsoft of the day back in the dot-com era. It also dropped 90%. Again, 90% in your portfolio. And then it dropped another 60%. And guess what? It took 22 years to get back to even. And as of today or through Friday, 42.60 is Cisco. So it's below its peak. So you've made no money over 22 years if you bought and held Cisco. So where are we today in Cisco, the market? Are we here? Are we here? Are we here? Where are we? How long is it going to take for some of these stocks that are pulling down your portfolio to get back to even break even? right? This market has trained us to go ahead and buy the dips. Well, we're not in buy the dips anymore. So you got to be very careful, and you got to eliminate these type of stocks out of your portfolio as fast as you possibly can. That's it. Thank you for joining us. Our next update will be Monday, July 25th. Please don't forget to subscribe or watch one of our other videos. And thank you again for joining us. We look forward to seeing you next week. Thank you.